Hello, my name is Luis. This is a financial model for a gold mining company. I'm going to explain to you about these Excel sheets that is going to help you to analyze a gold mining project in a lot of that different variables or items in your project. So first of all, here you are, the screen manager. This Excel is going to help you to compare four different scenarios. If you want, you can build only one, two, three, or four. You can separate assumptions of some items of these variables. For example, you have revenues, you have OPEX, CAPEX, workforce, and debt. Then you will find a summary year. This summary year is a resume of all the variables together because this Excel is built monthly. I'm going to show you in a minute how you can add the information that it is you're going to analyze, and this is the summary of the year that you are working and comparing, depending on the production, the costs, the price of the ounce, and some other variables that are going to generate an impact on this model. So here you are. You can change the beginning of your model, for example, 2005 or 2026, and then again. The first variable is the price of the ounce. This is the average of the year. If you have a discount for the commercialization of gold, transfer date productions of the plant, transfer dates of the production of the mine, the tenor, the blending, head rate of the production, the ounce produced, the income, the cash cost of your plant, and here you're going to separate with this model the cash cost of plant, the cash cost of the mine. If you have one of them, you can separate, you can calculate and analyze them by separated. If you have both of them incorporated, well, you can work with this model too. And then you will find royalties and social contributions, some of the OPEX, security costs, workforce cost, some costs related by cash administration. So this model works based on an amount of US dollars per each tons that you produce or per each ounce that you produce. So this gives you an approach about an average of how much this group of costs you or costs to the company, and then you can have a margin or around this production. So you will have income based on the production, then you will have the cost based on this group of cost. How much costs you the production of an ounce based on your cost at the plant, at the mine, the royalties, social securities, workforce, and site administration, some others. Then you will have an EBITDA. You need a capex. You can add to it by month or by year, and then the model gives you a cash flow. You can discount, for example, taxes, some other cash flows, for example, interest payments and capital payments, and you will have a capital requirements and a cash flow around it. There are other sheets, graphs. These sheets give you a behavior or comparison year by year based on different or the main assumptions of this project. For example, you will have area at the left, the transfer days projected to be produced. This is an example based on at the beginning 100 transfer days to be produced. By the end, you will have 1,500 transfer days. To the right, this is a revenue. This is the income of the company based on some assumptions that you will have. A cash cost per ounce compared to the tons of ore from the mine. This is the grade of the tenor blending compared with the ounces produced in the project. Here you are the price of the ounce projected, which is 2,700 in this comparison of the revenues and the income, the total margin or the total gains of the project. Here you are some other cash and EBITDA generated by the project. Then you will have capex, free cash flow. Then again, you will have some important information for the construction of the capex versus the margin. The capex discriminated by plant, by mine, by exploration. The capex budget separated by each year in its item. The cash cost annually compared with the price of the ounce, and the margin or net income or gains to be generated by this project. Also have some other information when you can build your own graphics that you need to build the comparisons of the project. There are also the possibility to compare scenarios of production. For example, this one that is going to help you to compare what about 1,500 tons per day versus 300 tons per day, and some other important graphics that you will find for investors, or some others to give you more tools in these Excel sheets for your purposes. These are other scenario comparisons, like tons per days to be produced and profit to be generated by some different scenarios. Next Excel sheet is assumptions. You have the variables, macroeconomics variables. You can add them monthly. You can change the beginning of your model here. There's an example beginning in January 2024. You can change it and use it at the beginning of 2025, or you can also use that different year for or month by the beginning of this model. So you have macroeconomics, growth, CPI, exchange rate, some other costs or taxes, to price of the ounce based on your projections and analyze different scenarios. A discount for commercialization. In production, you can add monthly the tons to be produced or processed by the plant of ore, the production of the plant, the production of the mine, the productivity of the capacity to working during a hard working on 100% of your working hours, or you can add some stops to maintenance of the plants. For example, you can add some maintenance too. The toner blending or head grade estimated in your calculations of the gold based on grams per ton in your scenarios. Material recovery, some level, some loss to have into account for gold processing in the plant, or gold lost during the production or the plant. You can add here some costs based to the plant based on the on an ounce per US. Here is some based on some studies based on the amounts of ore to be processed in the plant. Here you will find here some ounce into the model. You can change it, but if you want, you can leave it there. For example, what about if you produce more than 400 tons per day, or less than 300 tons per day? So here you are $126 per ounce. You can change the model here if you want. For example, for the mine, you can also have some variables like what about if you produce less than 300 tons per day? Then you will have a mining cash cost of $800. You can change it if you want based on the cost on your area or your country. OPEX, exploration, diamond drilling, some others, security, you can add this information. All of them are based on ounce, US dollars per ounce, and based on the production. Workforce, site administration, and some other environmental issues. You can also add the maintenance CAPEX, plant CAPEX, mining CAPEX monthly. Exploration CAPEX, you have some variables in the working force, some how many days you pay your debts to your third parties in your company. So the waterfall, this worksheet is based on US dollars, based on the information that you give into the assumptions and some other variables. And here you are now the result of this. First of all, you have the resume of the information, and there are this information based in US dollars, in millions of dollars generated for each item. Cash cost, first of all, that you have income, you have the resume of the model, and then you will have costs, mining costs, material royalties, social contributions, OPEX, workforce, site administrations. That you will have a CAPEX. Everything is based on US dollars. You can change the exchange rate. You can personalize and change the variables that you want here in this financial model. Some information about the debt. By the end of the exercise, you will have a cash flow, a free cash flow, and then you can add more information about debt and some other cash flow. Then you have financial statement sheets. This gives you information about the behavior of the income statement by the revenues. Then you can see the costs of the production, have an EBITDA, depreciation, amortization, some financial expenses like interest rates, some payments, taxes, and then you will find a monthly net profit of the operation. You will find a balance sheet assets and some main accounts of the mining or the project. If you want to project them, try to simulate how it's going to be the behavior of those main accounts. If you want, have some equity and other debt of your balance structure. Then you will have free cash flow and the behavior of this operation in financial information to compare your operation. Next sheet is CAPEX. Again, is built by month. You can separate the CAPEX by the item of the investment or the capital expenditure that you need to do. For example, roads, construction, certifications, equipment, machinery, office equipment, computers, communication, transportations. Then you have a group of for your capex, and you can add some other expenses that you need to have an account for this operation. You can project the debt if you have an important debt to be used in your capital structure of your project by interest, the payments month by month. Even if you have some structure of that or different, you can use this information to have into your projections into your project. So thank you. I hope this Excel helps you to analyze your gold mining production company. This Excel model is for sale. The information of this Excel is at the description of this video. You will find the information if you want to buy this Excel model. The whole information and the process is the description. Hope this helps. Hope this information and this tool helps you to save a lot of time each of your model construction and all the variables that you have need to be into account. This tool is going to save you a lot of time and a lot of money building your own model. Thank you and have a nice day.